key learnings moving from asset manager to being a miner. Okay, one's paper-based theory. A lot of, and you'd have been a lot younger then, learning different sets of skills. What do you think you've learned from that first acquisition? Because you bought that back in 2011, at peak of the market. Okay, so do you look back and go, we should have paid a lot less? Maybe we shouldn't have done that deal. It's only going to work at today's prices, right? So is that a deal that you're looking back you'd have done?
It's hard to put a totally clear lens on it because it was what got us in the game. Of course, I wish I bought it 6 months later, never mind 2 years later. If we'd waited 2 years, in that case, the asset would have just been shut. But like I said, the primary thing is like, how do you ride the cycle? That doesn't mean you can't do deals on the way up or even near the peak, but it should be a bit of a different deal, shouldn't it? So we structured that deal in a way that it was a $30 million purchase price, of which $10 million was cash. So that was money in and right out the door. $5 million note. So we did pay that out of cash flow. We paid IM Gold back over a period of a couple of years, and didn't have to do a financing to do it. It was under our own steam. And the other half was in paper in Newco. So that was there was no royalty, there was no residual ownership at the operating level. That was a way of back-ending it, sort of to de-risk it, if you will, and of course leave some upside if gold had done something different for IM Gold. So structurally we can deal with that, but of course, if I had a time machine, I would say let's buy this asset in 2013, not 2011.
So first deal, like you said, it got you into the game, and sometimes that's the most important thing. So you've overpaid, you've learned some lessons. So what were the lessons that you applied to the next deal, which you did in 2015?
Yeah, and we structured it. There's similar aspects to it. That one already had debt on it, and that was what had got it into that sort of process that had appeared on our desks. And that one we were able to we're the beneficiary then of a couple years of bear market in the gold market and buyer's market, if you will. And we were able to minimal outlay of stock, almost nominal outlay of cash, less than $1 million, really just covering people's bills. And then assumption of debt, which we restructured substantially to be heavily in our favor, unsecured, subordinated, no cash interest, very flexible terms on repayment. And of course, that was one where we picked up what was at the time 1.6 million ounces at all categories, now 2.4 million ounces. So if you look at our acquisition cost per ounce, it was almost zero in terms of equity and cash up front. And in deferred debt, we paid a couple dollars per ounce. So fantastic acquisition, one that could only be done at the bottom of the cycle. One thing I do want to clarify, the Mupani acquisition, it looked great for 2011-12. Remember, gold did hang on 1,600 plus for a year and a half there. Looked very bad for several years, but we've continued to produce. It's continued to pay all our bills. It continued to fund Galaxy. It funded the acquisition of the Galaxy mine and the care and maintenance cost there for the first couple of years. And now, 9 years later, with gold at $1,900 plus, the Mupani mine's a huge contributor. So overnight success, 9 years in the making, but now the purchase price looks fantastic again.